Lots of tax changes taking place in the new year.
Joining us now to sort it out, Bolanos, CEO of Wealth Management Group. Nice to see you back here.
Yeah, good to see you.
All right.
Crazy changes, right? Last week we were talking about Wall Street. I mean, today we're talking about income taxes.
Okay.
So, I mean, single largest overhaul to the tax code in 32 years. I mean, lowering of rates, expanding of deductions, but a lot of things are going to be. In fact, the first thing that comes to my mind is the salt shaker just got capped at $10,000. What am I talking about? State and local taxes.
Walk us through with specifically to Illinois. People are
to Illinois, I think to anybody who's in a higher tax state, they're about to realize that they don't get the deductions they used to. So think about this. Think about that power couple, you know, the high income earner. They're making $200,000 a year, have a larger home, pay $12,000 a year in property taxes. Normally, they've been getting a $22,000 deduction. Now it's capped at $10,000. That's the type of thing that's going to be showing up, and everybody can do their own math.
All right, so we have, but the big change is, what do we need to do today before we get to the new year?
So before we get to the new year, first thing I'm thinking about is this. It parries on what we discussed, you know, last week. The stock market hasn't been kind. We didn't get the big Santa Claus rally. Granted, the last couple days have been good. So if anybody has any investment losses in their accounts, I think they should look to sell those now, because any losses in your investment accounts can be used to offset gains. And again, any losses in excess of gains can reduce your income by $3,000. And there's something even more important than that. I call it use it or lose it. That's your flex spending account. And I pound the table on this every year because Americans put money away for dependent care. They put money away for unreimbursed medical expenses, and then they forget to turn in the expenses to get reimbursed. And your flex spending account is exactly that. Use it or lose it. So get on the phone, call your plan administrator today, and get your monies back.
If you do you have to have the receipt? Is that what you're saying? You need to make sure that you file those expenses, or you actually get out today and like go, you know, use it right now?
It could be both. I always make the joke that your local Walgreens and CVS has a run on saline solution the last day of the year, because people come in with an armload and just fill up the cart because they got to use all the money.
Right. Well, you better than losing it. So
yeah, very much so.
Also, you lower your income. You're saying contribute to your IRA or HSA.
Yeah, so that's the third thing. So book your losses, use your flex spending account. And the third thing would be anything we can do to save on taxes, because I thought the holidays are my biggest expense. Then I think it's my mortgage. Then I think it's the kids. And I go, no, it's taxes. So if I can contribute to an IRA, contribute to a health savings account to lower my overall income, that is a good move. And last time I checked, great companies of America are on sale. So now might be a good time for long investors, you know, long-term investors to fund that individual retirement account.
We talked about a little bit about the changes that we're going to face in Illinois. What surprises could we possibly run into?
Well, I think, you know, one of the surprises that's out there is, again, I said a lot of people are running into that cap of state and local taxes. But the second thing is, while home mortgage interest is still deductible, while charitable contributions are still deductible, it's harder to itemize. So let me give you an example. Think of that couple that has $10,000 of state and local taxes, $8,000 of mortgage interest. They're very generous. They give $5,000 to charity. Well, 10 plus 8 plus 5, we're good at math, right? That's 23,000. 23,000 is still less than 24 grand. So what does that mean? They're going to be taking the standard deduction. So you say, break that down. Essentially, that couple isn't benefiting from their mortgage interest deduction. That couple is not benefiting from the monies they give to charity. So people now need to go to the tax playbook and be a little bit smarter as to whether or not they maintain a mortgage and as to how they give to charity. I think that's going to be the single biggest surprises to people that are going to be filing in 2019 for the 2018 tax year.
You do have some positive changes that are taking effect in 2019. Let's get to those. Give us some good news.
So some good news. Some good news. Well, besides the stock market making a comeback the last week, the first piece of good for everybody is marginal tax rates got compressed. What used to be 39 is 37. What used to be a 28% bracket is 24. What used to be 15% is now 12%. So there is tax savings up and down the spectrum. That's good for everybody. And there's something else that's good for many more, which is, what if you got kids? A lot of people read that personal exemptions are gone and that people with families are going to be suffering because of that. I say not so, because there's a child tax credit that got doubled and it's a credit. Right? Not a deduction, a credit. We love credits. That child tax credit now for kids under the age of 17 is worth $2,000, and it's available to married couples that make up to $400,000 a year. That's a big benefit.
Yeah.
Does it matter how many kids? Is it
No,
per kid
you
then?
you can have the Brady Bunch and be good. I mean, think about this. You just don't want your child to turn 17 today because they got to be, again, what, 16 coming into the end of the year.
So under the age of 7, they have to be
Under the age of 17.
Makes
Gotcha.
it good to have the twins right now.
Yes.
Yeah, she's got some
Yes,
twin
very,
boys at
very
home.
much so.
All right, expanded standard deduction.
Well, I think, and that goes where, the expanded standard deduction is going to make it a little bit more difficult for people to itemize. Hence, it's harder to take charity, harder to take mortgage interest. But for a lot of families, that expanded deduction of $12,000 for a single filer, $24,000 for a married couple, that's going to usher in an awful lot of tax savings. So I think, the moral of the story, what we're learning is everyone's tax picture is totally unique, and there are going to be winners and there are clearly going to be losers under this new tax code, and you probably won't know which one you are up until you do your 2018 return.
Gotcha. All right, well, a lot of good advice in there, Craig. Really appreciate it.
Thanks for being here.
Thank you.
Happy New Year to you
Yeah.
as well. All right. More information, check out Wealth Management.